Yeah, and you could put smaller pieces across more deals in passive, so you could test the waters in passive a little easier. So theoretically, let's say it takes X amount of dollars to go and try that one house actively. You could spread that money across 4 to 8 opportunities, often that down payment, and then you've at least got more diversification, even if it was the wrong path for you. So that's a good point. Not that I'm advocating that anyone starts active. I mean, really, if the optimal thing is if you can figure out what's the best fit for you to begin with, obviously.
Hmm. All right, so we've talked about active versus passive. We're trying to figure that out. What else should we be thinking about? Is that limited partner
Sure. I would
investment?
say step two, if you're brand new and you say, okay, passive is definitely the right way for me to go. Then the question is, what do I need to learn before I dip my toe into something? So my recommendation there would be a couple things. Number one is, take it slow. And if you can focus on one asset class first, that's probably best. So if you say to yourself, look, I like the idea of investing in apartments. I can understand them. They're not as complicated as self-storage or assisted living, for example. So let's just focus on multifamily, because that's actually very common for people to start in that type of larger building. Then the next step is, well, how do you learn about it? And so that's actually kind of trickier than it sounds, right? So the way that I learned and the way that I recommend is what I call opportunity exposure. If you say to yourself, look, I want to invest in a 1 to 300 unit apartment building, and how do I look at 20 of those opportunities to compare them all and understand them better and see the differences, then the most efficient way to do that, in my opinion, is to go onto a bunch of crowdfunding sites online, real estate crowdfunding sites, and just, in your pajamas, you can do this in 2 hours and just download 20 opportunities. Now, I don't know if you want to get into more detail about accredited versus non-accredited investors. You got to be an accredited investor, but assuming that most of your listeners are accredited, then that's actually, in my opinion, a really good second step. Focus on one asset class, try to really understand it well, download those opportunities, compare them all. And what you're looking to compare is both the structure for investors, whether it's a preferred return, what splits you have to give with the operator for the profits, fee structure for the operator, management fees and other fees, acquisition fees, disposition fees, there's other fees. And then you want to look at their assumptions and see, were they conservative or were they very aggressive? And do they make the numbers look better than they probably are going to be, or do they actually look worse to build long-term relationships with investors and overperform? All these things you learn over time by reading a lot of opportunities and getting what I call that opportunity exposure. When I was first starting back in 2002, I had to go network to find these opportunities because they're not allowed to be publicly marketed. And it took a lot of in-person meetings across LA many, many nights. Now you can literally go on in 2 hours, download 20 different apartment opportunities and read them all. So it's much more efficient than it used to be to take this step.
I appreciate you putting that out. I've not heard anyone say that before, like just go to a crowdfunding site so you can just quickly look at all these things that you've never seen before and try to compare one to another and learn really fast that way.
Yeah, I will say one thing though. So the crowdfunding sites are all different. Some of them will pull people together into a single company or LLC, and then they take a portion of the profits. And you have to be mindful of the fact that that means that if you're investing in the crowdfunding sites LLC versus directly with the sponsor or the operator, that the returns will be lower because they're a middleman. So you have to keep that in mind. Okay, that's the one quirk with downloading stuff from the crowdfunding site. Some of the crowdfunding sites though are just listing sites where they're not a middleman. There may be a fee just to list an opportunity, and then you're going to go direct with the operator. So it's important to distinguish whether you're investing directly with the operator or through the crowdfunding company that they're putting together for the returns. But everything else, all the assumptions, how it's generally structured, everything, you can learn all that regardless of which two ways you're looking at.
How have you found the best way to educate yourself?
I mean, it's not efficient, but for me, it was all going. I went to probably 2 to 3 meetings a week for years in LA, literally. And I was younger. I didn't have kids. I wasn't married early on. So it was a good timing for me. But that's literally what I did. And I still continue to do that to today, in that I actually now have a much bigger network. And so I get a lot of opportunities coming to me through my network. But I still look at opportunities all the time, see how they're structured here, compare notes with other investors. Networking with other investors is a great thing to do as well. And you can accomplish that at in-person meetings. And if you live in a bigger city, a little bit of it online now as well. But yeah, I literally learned that way that I was recommending. And but what I learned is that investing passively is truly a team sport. If you want to get best access to the most deals, get feedback on what people thought about an operator, et cetera, it's all about the networking. I can't even think of an opportunity I found that I didn't find through networking somehow. I mean, that's what it takes, because most of them are not allowed to be publicly marketed. So you've got to find them. They're all private opportunities.